What if I told you I discovered a higher time frame bias strategy that takes only 2 minutes of analysis? I have used this exact system to make over $100,000 with prop firms, and I've recently passed multiple challenges using this exact system. Now, here's just a few examples from the public telegram that I called out just this week. So here is a before and after of the S&P 500. It was a trade that we called in the public telegram. Again, it's 100% free, where we use this exact system in order to call this move on the S&P. And again, this helped me pass one of my evaluations. We also had another example here on gold, where we called out specific levels based on higher time frame bias. And again, the market gave us over a 300 pip move. And again, we called it down to the 2300. Again, timestamp April 16 was the exact date that we called this. You guys can go back in your charts and see it for yourselves. Now, if you want to follow all my trade ideas throughout the week using this and many strategies, then I suggest that you guys, join the free Telegram. It's in the description below. Anytime I talk about any specific system or strategy, you guys will see me implement it live for free. So what is the exact system that I use in order to kind of identify my higher time frame bias with very clean accuracy? Now, first of all, I want to give out a shout out to Tom Dante. He's the one who I kind of learned this from in terms of like how to make engulfing bars a lot more powerful. So for those that are not aware, engulfing bars is essentially when you have like a bullish candle like this, and then it's kind of overturned with a bearish one. Essentially, the candle engulfs the prior candle. However, Tom Dante, in one of his teachings, again, someone that I've paid for specific courses and educational content, he uses engulfing bars with one very key component, where he requires an engulfing bar to take out the prior candle's high before having that move lower. So this is where I put in the rules. It must take out the prior candle's high. And again, this is for the bearish engulfing bars. Price takes out the prior candle's high, and then we close below. So the candle's opening and closing price. So whatever the prior candle is, right? If it's a bullish one, it could even be a bearish one, that's fine. But as long as it closes below both the opening and the closing price. So obviously for this bullish example, we have the price open, we have the price close. This example, this candle closed below. So this would be an engulfing bar. Now, this is very powerful because if we can identify these on the charts, we'll be able to kind of anticipate that potential third, fourth, fifth candle to that downside. So this will give us the trigger for a potential bias. Now, before we get a little bit more into that, we're going to also obviously cover the bullish engulfing bar. So it's the same thing, but in reverse. It must take out the prior candle's low. It must close above. I don't know. Yeah, so I forgot to make this little adjustment. But again, it must close above the prior candle's opening and closing price. So in this example, price closed bullish, and it closed above the prior candle's opening price and closing price. That is extremely important. It doesn't have to close above the high, as long as it does the open and the close. For me, that is perfectly 100% fine. Now, how do we trade this or use this for a directional bias, right? That's the whole point of the video. How do we go ahead and use something as simple as this for a directional bias? And I know most people are thinking, hey, this is a retail system, engulfing bars. But again, guys, stay with me. I'm going to show you guys exactly why this is very, very powerful. So let's just say we're at a higher time frame premium level. So this premium level, it could be anything. It could be a fair value gap. It could be a higher time frame liquidity pool. It could be whatever the case may be. The thing is this: when we identify a potential higher time frame premium level, so let's just say we want to identify our ranges. So a premium range and a discount level. Ideally, if let's just say we're looking for bearish, as in this example, we have a discount level that has not been traded to. So if we get our engulfing bar, again, where price raised the prior candle high, it closes below. Why is this significant? So let's talk about the significance for a second. Why is this engulfing bar very significant? Because think of it from this context. If this is a daily candle, or if this is even a weekly candle, which again, I personally prefer it on those time frames, but we'll get into time frames in a little bit. if this is a weekly candle, think of the context that this implies, that the market ultimately took out that weekly candle's high and we closed below the opening and the closing price. So what does this indicate? It means that the market swept liquidity and there was displacement to the downside. Those are the two key components when we're looking for trades that typically will help us identify, very explosive moves. So this is why the engulfing bar is important with this context of taking the prior candles high, because it gives us the framework and the notion that the market has taken its liquidity and now there is clean displacement one side to the marketplace. Now, when we identify a key level, like, hey, listen, because again, you don't want to just take any trade that has an engulfing bar. But if this is, again, if a weekly candle, we know that, and there's a discount level that has not been traded to, we know that the next candle could be something like this, where the market, again, has the opening price for the next candle, and we trade up, and then we have a displacement lower, and we have two consecutive bearish candles. So how do we trade this? So in the engulfing bar, what we typically could do is look for the PD arrays on the time frame lower inside the 25 to 50% of the range. So you could draw, and I'm going to show you guys a bunch of examples of this. We can draw a fib from the high to that candle's low and identify the 25% mark, the 50%, and the 75%. And I say ideally doesn't retrace to 75% because, again, if we're going to displace, we're typically not going to have too much of a deep retracement, and it's typically just going to have a very explosive move to the downside. So let's just say the next candle opens up. Ideally, and this is why I mentioned it here, ideally we have that candle's opening, and then we use the concept of power 3, where we're anticipating that next weekly candle to potentially have a move above the open into, let's just say, somewhere in the 25% or the 50%. It depends what PD array is there. So if there's nothing on the 25%, maybe we use the 50%. I'll go through a few examples there. But the whole goal is that we want to see power 3 of next candle, the market push up, reject, and then we start to flip and the candle starts to go ahead and become bearish into that discount level that has not been traded to. That's honestly the key component of this whole idea. Now, the goal again is to identify these engulfing bars at key levels, and then we still have to understand what range we're in so we know where we can run the trade to. So once identified, we then look for an opposing PD array or reference point where the market may look to reach into short term. We just covered this. And again, it's very, very crucial that we use the concept of the engulfing bar with these contexts to create a stronger framework. So let's get ahead and get into the time frames I use for this. For me personally, I use the 4-hour, the daily, and the weekly. And again, you guys can go ahead and experiment on other time frames. It's all there. At the end of the day, if we have a weekly chart or a daily chart or a 4-hour and we see it, we just have to identify potential ranges. Again, I talk about it all the time, but the reason why I like the daily and the reason why I like the weekly is because it has a much bigger range. So again, there's more pips for us to potentially profit in. So even if we don't catch the full move, but if we can get in sync at some point in the week, there's still a piece of the move that we can kind of capitalize on. So let's go ahead and let's look at some examples of the things that we talked about in the public Telegram. So a few of the examples that we talked about earlier, and again, guys, if you want these PDFs, there's a section on my website, link in the description, to get access to all my presentations. That's where I upload them. So it's at tradeandtrade.net. And if you want to, again, see me utilize these concepts for free, make sure to join the public Telegram. Now let's go ahead and let's go into TradingView. Now let's go ahead and I'm going to use this example of Bitcoin. So for Bitcoin, in the public Telegram, I was talking about that I wanted to see Bitcoin down to $57,000. Now, it didn't get there, but again, I'm going to talk about how we can still use this system overall to kind of ultimately create a bias and then still be in profit and potentially make money. And that's why I like the higher time frames, because there's enough range to go ahead and make money. Now, look at this candle here. This is the exact candle that I was referring to. And so let's break it down, right? We have that candle opening price right here. Price went up. It took out the prior candle's high. And again, because it's a weekly time frame, this is taking out a weekly liquidity pool. It also took out that candle's high, but nonetheless, we also dropped lower and we closed. Again, this is very key that we closed below this candle opening and closing price. Now, when we go ahead and we also kind of like, all right, so where are we coming from? We obviously were at all-time highs here at Bitcoin, so we were at a higher time frame level, and the market has been, it's been kind of surging higher, no real reversal point. So it's very common to expect a potential reversal after all-time highs. Again, doesn't mean it's going to go all the way lower, but where is the next discount level, which is right here. So when we identify, okay, we're at a premium level, and here's the next downside discount, and we got our engulfing bar. Now, let's go ahead and we talked about how we're going to go ahead and use this. So the next weekly candle, we're looking for that opening price. We're looking for that power 3 push into some sort of discount inside of this candle. Now, when we draw out our Fibonacci, so this is what I mean by we draw out the fib. We draw the fib from the high of the candle down to the low and vice versa for longs. But we go ahead and we put the range divider. So now there's 4 levels that we're trading from. The 25, the 50, the 75. So we're going to go ahead and we're going to look to see, hey, is there any discount? Now, obviously, price closed above the 25%. So we're going to go down onto the lower time frame and see, hey, what is going to be down here to see that is there a potential premium level that we can go ahead and sell short? So is there any PD array? Is there a fair value gap that's present? And just for argument's sake, look how price on that next weekly candle again, we tapped right at that 50%. We did hit that candle low. So again, as soon as the market pushes down to that candle's low, especially if we opened, rallied, and dropped lower, this could be a potential first objective. Because again, this is a weekly time frame, guys. This could ultimately be a situation where the market, drops lower. We're in decent profit. It doesn't close below. So, but again, usually not the best sign in the world. But again, it gives us an opportunity for a very solid trade. And when we go down to the lower time frame, we're going to go ahead and see on the daily time frame during that moment. Let's go to the 4-hour. So during the 4-hour, it was on this specific weekend here. So from that candle's high down to that candle's low. So we have our ranges defined. So when we go ahead and let me play this back. So right here, this was pretty much on Monday. So this was Sunday going into Monday. Perfect. Inside of that 50%. What do we have that's right there? It's that fair value gap. And again, this was a trade that I took. And this was the premise of me looking for that move lower. And look how price reacts right at that fair value gap. That was along with the 50%. And again, we know that this is a potential low. So this could be our potential first objective. And this could be objective number 2. And we see that price ultimately blasts lower. Takes that, and then obviously, we start to kind of like play around that prior week candle's low. And that's why sometimes it's not the best that if we don't have a candle closure, because, it just looks like the market may have swept liquidity, and now either we're going to start ranging or we might sweep up one more time. So regardless, I gave a great trade opportunity. Now let's go ahead and let's break down the S&P 500 and the trade that we took recently, as well as the short trade that we took about a few weeks ago. Now again, guys, I don't even have to say it, but you guys can possibly see this. Let me first go to the monthly time frame so that we can kind of identify our discount and our premium level. So so on the monthly time frame, we have our discount level, and then when we go back to the weekly time frame, what do you see right at the high of the S&P 500? And if you've seen it, perfect. It is that engulfing candle. Again, we see the market take out the prior candle's high, and then we close below that prior candle's opening and its closing price. Very, very simple to identify. Now, again, it also took out that prior candle's high, so it's beautiful. And then look what happens on that next candle. This is exactly what we're trying to do on every subsequent move lower. What we're trying to do is, okay, if we're nowhere at a premium level, because again, the market has kind of just been pushing higher, we're above all-time highs. At some point, there is going to be some sort of reversal. Again, this was a very nice reversal potential trigger in here where the market is kind of telling us like, hey, this might be a short-term reversal. At the very least, again, just into that discount level. Doesn't mean the S&P 500 is going to go to 0. It doesn't mean we're going to go and reverse completely. But where's the next discount level? And that's the next discount is that monthly fair value gap, which the market traded into, and then we had a very beautiful reaction. But this is what we're trying to do. If we can identify this could just be the turning point for the marketplace to head lower. And because it's a weekly time frame, guess what? The next candle, again, the power of 3. What do we have here? And if we draw the Fibonacci from swing high down to swing low. We pierce into that 50% mark, and then the market ultimately has a move lower. So again, I'm not going to go into the lower time frame for this one specifically, but we would look for, hey, is there a, I'm going to go down to the daily time frame just to see, is there any potential? We actually, it's funny because we actually had a daily one right here where we took out that candle, pushed lower, and again, the market kind of came into OTE of that area before finally heading lower. So, and that's the thing, because the weekly candle, you kind of have to give it a little bit of time, because remember, the weekly candle isn't going to close right away. So if, let's just say, for example, we hit that level on like a Monday or Tuesday and it kind of consolidates, remember, this candle doesn't close until Friday. So that's something that we have to kind of keep in mind. But nonetheless, this is the type of reaction that we're looking for. And just like what I was talking about the BTC example, this is why I like to see the candle closure, because again, it indicates even further weakness. And then look what happens next week. Candle price pushes up, and then we have that move lower. So again, this is the power of the engulfing bar. Now let's go ahead. I'm going to show you guys the final example of the long that we took just to start off the week. All right, so now that we're here on the 4-hour time frame, we're going to go ahead and we're going to play this back. So if you guys already kind of like in the mentorship, you already know about like the failed structural play, where essentially I'm just looking for the market to kind of, once we're at a key level, right? So once we're at this monthly fair value gap in here, and let me go ahead and replace this level. Once I know that, right? So I'm looking at, okay, is what kind of confirmation is the market giving me to go long for a potential, right? Again, I'm not looking, I don't know if the market is going to bounce here. I don't know anything. I just know that this right now is our current range where we have equal highs and we have this imbalance that we talked about. So when I start to see something like this, right, where the market has from swing high down to swing low, the market potentially making a lower high in here. But however, look what happens. The market ultimately fails to push lower. So what does this indicate to me, right? Anyone who went short on this candle is now trapped. Anyone who went short on the retest, looking for that new low to get hit, is now trapped. And how do I know that they're trapped? Look at this candle bar over here on the 4-hour. What did the market do on this candle? Again, what did we do? We swept the prior candle. And again, it actually swept a few candles, pushed up, closed above, and now we have a potential upside objective. Again, this was not hindsight. Now, obviously, when the candle closes, I can draw the 50%. I could just draw the candle dividers to see, hey, where can I look for a potential entry? And again, there was actually a fair value gap right at the 50% mark on the same time frame. And look what happens. The market has that beautiful expansion higher to that upside objective. And that's all we're doing here. We're just trying to find the market giving a range from discount to premium to discount. And this engulfing bar gives us a potential footprint of like, hey, you know what? This is a potential for the market to kind of push in that direction within the proper context. So I hope you guys enjoyed this video. If you guys want to see more examples and see me break this down even further, let me know in the comment sections if you guys want a part 2. And again, if you're not, make sure to be subscribed, because I'm revealing so many different tips and tricks for you guys to be able to identify bias, to enter on lower time frames, and it's going to be the most simplest types of concepts explained here on YouTube.